Welcome back. Now, in September, inflation ticked up marginally from 3.3% to 3.4% year on year. The slight increase was driven by costs associated with housing and utilities, as well as food and non-alcoholic beverages. On a month-on-month basis, inflation increased by 0.2%, all while within the SARB's 3 to 6% inflation target band, which is expected to be formalized as 3% in the upcoming mini budget. Independent economist Elize Kruger joins us with her assessment of the print. Elize, thanks so much for your time this afternoon. As mentioned, inflation ticking up slightly to 3.4% in September from 3.3%. Maybe let's start off with those market expectations. Pretty in line when it comes to that. So no real surprise here.
Yes, indeed, darling. I also expected a 3.5%, so slightly below my own forecast.
Okay.
But I think Reuters was at 3.5, Bloomberg at 3.4. So generally speaking, more or less in line with expectations today.
Now, food prices remain a key concern, though we are starting to see inflation there taper off from 5.2% in August to 4.5% in September. Now, some economists say that prices may have started peaking. Do you agree, especially when we are still seeing, a push and pull factor in that basket?
Yes, on the food price basket, I think we are seeing still different forces playing out. On the one side, we saw quite a notable decline in veggie prices, like a 5.5% monthly drop, and veggies only 1.2% up on a year ago. But on the other hand, we still see a lot of pressure on the meat price side, and that is still the aftermath of foot and mouth disease and the impact thereof in the South African economy. And, what I hear from farmers in the Free State is that actually it's not sorted out completely yet. So that is obviously still also, I would say, hovering into the prices if you look on the meat side. So I would say the food price basket is a combination of some, upside and some downward pressures evident in the different products.
And I remember speaking to another economist earlier this month on those lower potato prices, and I guess we are seeing that in play as well, as you highlighted that veggie inflation is ticking lower. Now, when we strip out those more volatile costs and zoom in on core inflation, it came in a bit higher as well at 3.2% year on year. What's driving that increase, and is this something we should be worried about?
So in the month of September is what we call a high survey month. We had the quarterly surveys of the housing component, rentals and owners equivalent rent, and those has got quite a biggish weighting in the core basket. And both those rentals and owners equivalent rent came out slightly higher than expected, with like monthly growth rates of about 1.1%. I had it in as a 0.8 in terms of expectations. So overall, the numbers are still moderate. It's like 3.2% on an annual basis. But in the month, I think it definitely resulted in that slight uptick in the core inflation number. I'm not concerned about this. As you mentioned, inflation remains quite close to the 3% level of our current band of 3 to 6%. And I think, from that point of view, I consider it to really be moderate inflation numbers in South Africa at the moment.
And you spoke about those rental costs, which have had an impact on the print for September. What's your sense when it comes to some of those increases that are coming through, and I guess consumers' ability to be able to stomach those increases, and just given that income growth as well hasn't really kept up with inflation?
Well, I would say in the past year, we've actually seen that, income growth has indeed, kept up as, if I can quote here the net salary index of Pay Inc. Take-home pay numbers, really showing that this year and last year, increases have been above inflation, especially if you think about inflation as a 3.3% average for 2025. And, the early indications from the Reserve Bank is that salaries and wages increased by more than 4% in the first quarter. And, like I say, other surveys like Payings data indicate even more. So I do think we have seen, the salary side looking better this year.
Okay.
But, obviously there are other items, things like electricity and water and so that have increased quite a bit more than the average salary. But if you look just at the level of around 4%, that's sort of in line with like food price inflation at the moment.
And how significant is that risk, Elize, what you just mentioned around higher electricity prices, higher prices for utilities in particular? I mean, even Governor Lesetja Kganyago highlighted this in the last MPC meeting, speaking of, some of those structural issues that could have an impact on that headline number.
Absolutely. I think that administered price component in our CPI basket remains, I would say, sticky, compared to other price levels in the economy. And from that point of view, I think it is really still, I would say, an issue to be addressed, especially if South Africa wants to move to a 3% target level for inflation. I mean, if you think about administered price costs, it is making quite a chunk out of a household's monthly expenses to pay your municipal account. And if those expenses continue to rise significantly above inflation and also above your salary increase, then it does erode purchasing power and the whole economy's ability to grow, and also the ability to get to that 3% target.
And that's what I was about to mention, that yes, we are seeing those salaries ticking higher, but costs are ticking even higher than one's salary, and that of course impacting then consumers' purchasing power. Lastly, before I let you go, then the last time we spoke, the Fed was still on pause when it comes to interest rates. Fast forward to some months later, we are seeing policymakers in the US easing when it comes to interest rate. How much of that could filter through to the SARB's next move, considering that many have said that the SARB has come to an end of the cutting cycle for 2025?
Yes, so on the US side, I think the economy is moderating on that front, and it seems like the further cut of 25 basis points is indeed expected by markets. Now, if we do see that cut in the US coming through, I mean, our interest rate differential with the US is actually creeping upwards. And from that point of view, positive for the rand exchange rate, but it also provides scope for the Reserve Bank to cut rates. If we think about a 4.5% CPI target, then I would say there's lots of scope for the bank to cut rates, because we are sitting at 3.3% in terms of average inflation. But we had the sense over the past couple of months that given that the bank would like to move to a 3% target in collaboration with National Treasury, and maybe we see that announcement at the medium-term budget policy statement mid-November. And if they go that route, then suddenly that scope to drop rates, has diminished in South Africa. So that extra, 1.5% in terms of the target level does make a difference in the scope that they do have to cut rates. So, given that they want to move to 3% at this point in time, I'm expecting them to keep rates just really unchanged in November, when they meet again. But, if the Fed, move does come through, if we maybe see further indications of rand strength, lower oil price, for instance, more factors pointing towards lower inflation, maybe we have a small window, but it's going to be a tight decision given the 3% that is hovering in the background.
So we wait in anticipation for that meeting in November. Elize, thanks so much for your time and just unpacking that inflation print for us this afternoon. That was independent economist Elize Kruger.